Most people are losing thousands of dollars on their insurance, and they do not even realize it. Not because they have the wrong coverage, but because they misunderstand one critical detail in their policy: your deductible. Today I will show you how this one decision can cost you money year after year, or help you save significantly if structured correctly. If you understand this properly, you will never look at your insurance policy the same way again. What is a deductible? Let us start with the foundation. A deductible is the amount you agree to pay out of pocket before your insurance coverage applies. For example, if you have a $1,000 deductible and your loss is $5,000, you pay $1,000 and your insurance company pays the remaining $4,000. This structure applies to auto insurance, specifically collision and comprehensive coverage, home insurance policies, and commercial property insurance. It is important to clarify something that many people misunderstand. Liability coverage typically does not have a deductible. That means if you cause damage to someone else or injure another person, your insurance coverage applies immediately, subject to your policy limits. The deductible is mainly tied to damage to your own property. This distinction is critical. Common misunderstanding. Here is the most common mistake clients make. They believe a lower deductible always means better coverage. That is not correct. A lower deductible means you pay less at the time of a claim, but it also means you pay more every month. Insurance is a balance between monthly cost, out-of-pocket risk. When you choose a lower deductible, you are transferring more risk to the insurance company. When you choose a higher deductible, you are retaining more risk yourself. There is no universal correct answer. The correct choice depends on your financial situation and your risk tolerance. Why insurance companies use deductibles? Insurance companies use deductibles for several strategic reasons. The first reason is to reduce small claims. Small claims create operational costs. Every claim requires adjusters, administrative processing, investigation, and payment handling. Even small claims can cost the company a significant amount to process. The second reason is behavior control. When clients have very low deductibles, they are more likely to file claims for minor damages. The third reason is risk filtering. Clients who choose higher deductibles are statistically less likely to file frequent claims. Most people overpay simply because no one explains these details clearly. On this channel, we break down insurance in a way that helps you make smarter financial decisions. Now, let's continue, because the next part is where strategy becomes important. The hidden advantage. Insurance companies do not publicly emphasize this, but it is well understood in underwriting. Clients with higher deductibles are viewed as more stable and less risky. That means fewer claims on record, lower loss ratios, better underwriting profile. Over time, this can lead to more competitive renewals, better eligibility with preferred carriers, fewer policy restrictions. You are positioning yourself as a better client. Financial comparison. Let us analyze a practical scenario. Option 1, $500 deductible, monthly premium $180. Option 2, $1,000 deductible, monthly premium $140. The difference is $40 per month. That equals $480 per year. In 2 years, you save $960. That is nearly equal to the difference in deductible. If you do not file a claim, you keep all of that savings. At this point, you can see how small changes in your policy can make a real financial difference over time. If this is giving you a new perspective on how insurance works, take a second to like this video and subscribe to the channel. Most people never learn this, and it ends up costing them money year after year. Now let's look at how this actually plays out in real-life claims. Real claim behavior. Most claims fall into smaller ranges. If your deductible is $500 and your damage is $700, insurance only pays $200. Filing that claim may not be beneficial. It can affect your claims history and future pricing. Experienced policyholders use insurance for major losses, not minor expenses. When higher deductible is a bad idea, avoid high deductibles if you do not have sufficient savings. You rely on insurance for small losses. Your income is unstable. You would struggle to pay the deductible. Insurance should not create financial stress at the time of a claim. Application across policies. Auto insurance. Collision and comprehensive deductibles affect premium. Home insurance. Higher deductibles reduce annual cost. Commercial insurance helps control operating expenses. This strategy applies across your entire insurance portfolio. Deductibles are not just a number on your policy. They are a financial decision. When used correctly, they allow you to reduce your monthly cost, control your risk, improve your long-term insurance profile. If you found this episode helpful, make sure to like this video and subscribe to the channel so you do not miss future episodes. If you want help reviewing your policy and choosing the right deductible, contact Evertrust Insurance Agency. We will help you structure your coverage based on your financial situation, not just price. Our contact information is in the description.